Good morning. Welcome to the end of the week. It is Friday. It's February 10th. An interesting week, a negative week on the markets, but probably a week that was needed after some excessive risk taking up until now. We have a lot to get to today, but we also want to preview at some point the CPI report that's coming out on Valentine's Day morning. So Valentine's Day is turning out to be a pretty big day. You have some pretty big earnings reports as well. So hoping for some love on Valentine's Day. We'll see what happens if that CPI can get down. But we'll talk a little bit about that at toward the end of this podcast today. But let's start off with the news of the day, which is Russia's cutting its oil production by about 500,000 barrels of oil production per day, which is approximately 5% of its production. They say that this is kind of in response to Western sanctions. They figured out some ways around it and also just don't want to be selling oil under the price cap. I didn't, really think that this was going to be that significant, but it is moving oil prices higher today in a tape where the market overall is actually falling. So there continues to be some concern that higher energy prices could feed through. What's interesting with this is that Russia is cutting its production, and it typically doesn't do so without the blessing of OPEC. Usually, it stays pretty tight to the OPEC plus accords, and OPEC plus is committed to keeping production constant. So that is interesting. But Tom, I'm curious to hear what your thoughts are in terms of the ramifications of this move.
I think we're going to see oil prices go up. I think they've been maybe even perhaps undervalued here for a while. I think that the writing's kind of on the wall that China's going to reopen. Russia really needs oil prices to be high in order to sustain the war effort. I think they've basically done everything they can to sell as much oil at the highest price as they can in order to really fund their operations. There was a report that came out that they had sold like $3 billion gold out of their reserves last month in order to continue to raise money. So those are really their options. Their options in order to stay afloat are selling commodities. And so I think that despite what OPEC does, Russia is looking out for Russia right now, and I don't really know of anyone else who is. And so I think that that's probably something you can sort of hang your hat on, is that oil prices probably have bottomed out in the short term. They're probably going back up. Though I would say, as it relates to the overall picture, there was an article that came out this morning. I've yet to read it. I just read the headline. It's from Nick Timmerhouse, the Wall Street Journal guy we talk about all the time because he mostly watches the Fed. But the article basically says that if you really dig into the data, rising oil costs in 2020, 2021, 2022 were not the main determinant driver of inflation in the U.S. And so I think that's probably a positive news in terms of, once we get in there and read the article, dig into the data to see if that really plays out. But the fact that there's really more supply chain, pulled forward demand, all of the different money printing operations and stimulus packages are really what drove inflation, not necessarily the fact that oil spiked significantly, towards the end of last year.
So it wasn't Putin's price hike.
So it wasn't Putin's price hike, despite popular belief. So something to keep an eye on there. But we do have plenty of oil exposure. ExxonMobil obviously has been the big winner over the last couple of years in terms of stock price, and we have a nice healthy position there.
Well, I think what you're saying too is, OPEC has increased production in the back half of last year. China was not open, and now China is reopening now, but they're also getting some more oil from Russia. But then I think probably the biggest move, the reason oil hasn't really moved a lot higher right now is because you have a bunch of oil consumers, particularly companies that use a lot of oil products, hydrocarbon-based products. They're hedging. So if you're a big consumer of diesel, I'm talking to people who have hedges on their diesel who I didn't really think were used to hedging. And they have hedges over the next 6 months, 9 months, 12 months. And so basically what happened was in the back half of last year, you had a bunch of these companies hedging out oil, basically making their purchases in advance. So you don't have that buying pressure right now that you would otherwise have. So I think that oil could remain relatively subdued over the next few months, and then we'll have to see what the economy does from there. But I would not be surprised to see oil prices head higher going into the summer months. And I think that's probably the base case for a lot of people, a lot of analysts out there. Do I think it's going to go to $140 a barrel again? No, not in the near term. But I do think that that's playing a role. You're also seeing a little bit more on the war effort from Russia overnight. They're really trying to ramp that up, and I think that's probably pressuring oil prices higher this morning. So something to watch going forward. Microsoft, we have some company news today. We'll start off with Microsoft. They formed a metaverse team 4 months ago, and they're cutting all of those employees now 4 months later. So we're off metaverse onto AI. Now, some of this was due to the fact that Microsoft was contracted with the Army for the HoloLens 2, but Congress rejected that, and that was going to bring in $400 million. So, part of this is not in their control, but even so, it just, follow the bouncing ball. What's the shiny object right now? And it's not metaverse, it's now AI.
Yeah, it's been an interesting change, and it happened very quickly. And we saw it with Facebook Meta getting crushed last year. People just weren't, at first they were really into it. 2020, 2021, when electric vehicles, Bitcoin, all of the future tech that everyone was really excited about suddenly became toxic. We saw all these things come down, and now we're seeing it go all the way through to Microsoft. But the question is this AI thing just going to be another fad? Or are we just going to ride stock prices up based on this and make sure to be trimming all along the way, because it isn't really a technology that's come through? I mean, Google's just gotten crushed by the fact that they put a Twitter ad up where their AI chatbot gave a wrong response and they failed to notice. I mean, it's down 9-10% just in the last couple of days based on that. And nothing has really come to fruition. It's not like Microsoft suddenly took 15% market share from Google and everyone's suddenly going to Bing. But if we're sitting here in 2035 and everyone's like, hey, let me Bing that, you let me know, because Google is the Kleenex of search engines, and I think it's going to remain that way. So I think, in my opinion, this AI thing is overblown and probably will not be the narrative in a month or two.
Yeah, I think that certainly, we've been through this before. We've seen 5G, we've seen Internet of Things, we've seen electric vehicles, we've seen nuclear fusion multiple times. We've seen this stuff. And graphene, and we will see at some point machine learning take the place of artificial intelligence is kind of the buzzword. So, it's interesting to watch. It probably has some ramifications over the long term.
Data mining,
but at the end of the day, I think we're all sitting here and we know that computers will be more powerful and more productive in 10 years than they are now. Know that, and the buzzwords will kind of take care of themselves.
Yeah.
And we probably won't be buzzing about AI in 10 years. It just will be how we live.
Yeah.
So, next big story is Lyft. Lyft's down 32%, which was really a surprise to the market because Uber had pretty strong earnings. But what Lyft had to do was they had to record a massive insurance reserve to the tune of $375 million. It was an insurance reserve adjustment, which is a fancy accounting term, basically meaning that going forward, insurance costs are going to be significantly higher than they were in the past. And they're trying to reserve against that ahead of time. For context, $375 million is 35% of what the company did in revenue last quarter. So you say, well, one time, $375 million, but that's of revenue. If you think that many companies have 15, 20% margins, you're swinging to a negative, a loss very quickly. Problem is, Lyft doesn't have 15 to 20% margins. And best of times, it has 0% margins. So you're talking big time losses for Lyft on this insurance reserve liability. My view is that a lot of these vendors have, and this goes for a lot of these startup companies, I think that they're started by tech people, not necessarily business people, or business people who are very narrow focused and don't understand the broader context. They think they can come in and disrupt when they don't really understand the rules, the regulations, the liabilities, all the other costs that go into it. You're seeing that with Lemonade, the insurance company, as well. Seen that with Rocket Mortgage and the cyclicality of it. You've even seen that with some of the e-buyers, the online buyers of homes like Zillow and Redfin, Open Door. They thought it was free money. They thought we're going to disrupt this, Carvana, and they realized that we didn't think about something, and it usually comes back to bite them.
There was an interesting, I wonder if you could even find it. There's an interview with Mark Cuban from all the way back in like 2000, probably 12 or 13, where he talked about there'd been a major shift in how companies go public. And he used Uber as an example, which is that it stays off the market. It's 100% in venture capital all the way until it hits, a market cap of, double digit billions and then goes public. And so by the time it gets to market, it's never actually been physically tested by the broad markets. When people aren't participating in it, they aren't buying and selling the shares in an open market. And so there are all of these, quote unquote unicorns that were going to hit the market over the next 10 years that were not going to be actual viable companies because they've just been continually inflated in value on the private side. So all those people are going to make a ton of money. But I mean, when you look back at Amazon, like it went public very early and it's had wild swings over the history of its life, but it's ultimately become a viable company. And it was sort of like the chase after .com companies early, where it's like they hit the market, everybody buys in, suddenly they realize it's not a viable company, that company goes zero and goes away. But we skip that whole process by building and building and building these VC firms, and then they go public, and then it turns out they aren't viable at all. They've just been, in a hype machine, losing money on purpose to gain value and ultimately get to a massive IPO. And I think we're seeing the ultimate result of what he was talking about that time, which is that Uber and Lyft can't really make it work. Carvana can't make it work, but these are all super hot companies before they went public. And a lot of people made a lot of money on the VC side, but once they ultimately became tradable public companies, they all kind of end up in the toilet.
Disrupting an industry is extremely hard to do.
Yeah.
And it doesn't happen with dozens and dozens of companies every year. And I think that, it can definitely happen. Netflix did it, for example. Amazon just about did it. But it's very difficult to do. Shifting gears to Ford. Ford has really been, after kind of the golden child in the back half of last year, especially in Q3, it's really had a rough go of it over the last 6 months. They had weak earnings, especially in contrast to GM, looked very weak because they still can't get the supply chain right. The quality of the product is not where it needs to be. And Wall Street Journal actually just came out with this article. Says Ford CEO tells employees they need clearer goals, performance metrics. And he basically says that there's a lack of alignment. The people on the ground doing the work don't understand the objectives of the company and what the company is actually trying to do. And so you have this disconnect between the strategy and the ultimate products that are being rolled out. And so he says, tackling broader problems at Ford, such as supply chain management, poor quality, can't be done at only one level. And there needs to be clearer ways to help individual workers understand what they need to do to contribute to the car maker's overarching objectives. So essentially it is ask what you can do for Ford, not what Ford can do for you. That's what basically he's saying. I think, and I wasn't in the room, but if I was a worker actually building the cars and I saw this guy get up on Jim Cramer's show and all these other places and he's making a lot of money and he's telling me that I need to do a better job and it's not, he can't just run this company on his back, I'd be a little bit salty.
I mean, it doesn't help that also this week they announced the partnership with Red Bull in F1, which is the most luxurious sport. Now Ford's going to spend a ton of money building F1 cars, which I would argue has almost nothing to do with the business. But fun fact about Jim Farley, who's the CEO of Ford, he's actually Chris Farley's cousin, but he grew up in Argentina, I believe. We did a deep dive on it when he got announced, but he's like somehow Chris Farley's first cousin, but did not grow up in this country. He grew up in Argentina. So Chris Farley continues to touch all of us in a special way every day.
It's crazy. I mean, he says he didn't say this directly to his employees, I don't think, But he did on his earnings call last week say, and I quote, "To say I'm frustrated is an understatement because the year could have been so much more for us at Ford." I mean, you don't do that as a CEO. You lead behind the scenes. You don't go out and complain to analysts and say, "It's not my fault. I'm frustrated." And maybe he's not saying it's not my fault, but you just got to fix it. I don't know.
Especially in such a blue collar industry. I mean, you can't go around.
You can't go preaching to people on that
to manufacturing companies
who are actually working. PayPal reported earnings. Surprisingly, not much of an issue. You know, I think the big headline is that the CEO is leaving at the end of the year, which is notable given the fact that the company is a little bit neither here nor there. So that's going to be something to watch going forward. But Tom, let's shift gears really quickly just to finish on the CPI report, because we're getting headlines right now, and this was pre-planned, that they have adjusted the seasonal adjustments to the inflation print. So we now have core inflation in January that was up 0.4%, not 0.3 as previously reported. And that's because they changed some of the weightings within the CPI. They decreased the weighting on used vehicles, for instance, which was one of the biggest sources of deflation. And that's having an impact right now. And I imagine probably not a great impact on stocks, but it also sets the stage for potentially a higher inflation print on Tuesday.
Yeah, I mean, if you look at the numbers now, the month over month is the expectation is actually for an acceleration of 0.5% on CPI versus a decline of 0.1% for the previous month. So that's already pretty hot. The overall number is 6.2 versus a previous print of 6.5. So I think we're sort of set up here for a potential for it might coming in flat year over year, somewhere in the 6.5% range. I think that we're going to get a lot of volatility heading into that, but right now, just given the way things are, I think we might hit our first road bump with this report. And the market, I think, is already starting to price a little bit of that in. Though we get University of Michigan sentiment as well as their 1 and 5 to 10 year inflation expectations today. And those are actually higher than last month as well. So University of Michigan, their last print was their expectation on 1 year was 3.9, and the expectation, or at least the preview, is 4%. And then their 5 to 10 year is still 2.9, which is far higher than the Fed's target of 2% in the long term. So I think that's a little bit of a canary in the coal mine as well. So we'll see what those numbers look like this afternoon. I'm sure we'll discuss them on Monday. They'll probably have some readout on that in the weekly market briefing that's going out this afternoon. So we'll have a little bit of information there on that. But, hold on to your hats. We're seeing a sell-off in bonds that indicates that we're probably going to have higher inflation and higher rates. We talked about how strong the 10-year auction was this week. Well, everybody who bought into that unbelievable 10-year has now lost money because the 10-year is creeping back up to about the 370 range. And then the 30-year auction that went off yesterday afternoon was a disaster. So I think that long-term bonds, maybe not so hot, maybe not as in demand as we start to see some of the CPI information start to leak out.
And to be clear, I do think that we're of agreement that inflation's coming down, but there's going to be bumps as we go along. I mean, you look at a chart of the market over time and it's generally up, but there are movements down and, that change that. And I think that if you flip that chart, that's going to be inflation too, generally going down, but there's going to be periods. And I think we're in one where you have a momentary tick up. And I think that is probably one of the reasons that the market's selling off. So with that, have a great day, have a great weekend, and we'll see you on Monday.